And as central bankers gather for the Jackson Hole Symposium, crypto leaders are holding a summit of their own just down the road called the Wyoming Blockchain Symposium, drawing big names from finance, politics, and the Fed itself. The Fed's monetary policy path is becoming the anchor for the $250 billion stablecoin market. Under the recently passed Genius Act, starting 2027, stablecoins must be backed one-to-one with eligible assets such as the US dollar and some short-term Treasury bills. And this effectively intertwines stablecoins more closely with Fed policy. Now, when the Fed cuts rates, yields on short-term Treasuries fall, squeezing profits for stablecoin issuers. But looser liquidity could spur crypto demand. And a broader, weaker dollar could actually boost purchases of dollar-denominated stablecoins. When the Fed hikes rates, short-term Treasury yields go up, which means stablecoin issuers earn more from their Treasury holdings. And a stronger dollar can also make stablecoins less attractive overseas. And Washington recognizes how it could help fund the U.S.'s debt burden. Treasury Secretary Scott Bessent says he expects stablecoins to become an important source of demand for U.S. government bonds. Now, the stablecoin market is now worth about $250 billion, accounting for just a fraction of the $29 trillion U.S. Treasury market. But there are expectations that it could expand to $2 trillion in the coming years. One estimate ranks stablecoins as the 18th largest external holder of treasuries. But that is not without risks. With the large amounts of short-term bills held by stablecoin issuers, the Fed may struggle to steer interest rates smoothly, complicating its dual mandate of keeping inflation low and employment high. And if investors suddenly dump stablecoins, then the Treasury market could turn volatile fast. Now, globally, the picture is mixed. The Trump administration has embraced the Genius Act, but Europe views non-euro stablecoins as a threat to monetary sovereignty. Singapore and Hong Kong are setting up licensing regimes that welcome them. As stablecoins are fast becoming a tool of U.S. monetary and fiscal policy, the moves could have ripple effects around the world. And Chengyi Ong, APAC head of policy at Chainalysis, explains how global monetary policy could impact the way regional regulators see digital assets.
The fact that U.S. officials have not been shy about their view that U.S. dollar-backed stablecoins can be a strategic economic lever to preserve the centrality of the U.S. dollar in the international monetary system and advance national security objectives. I think for regional regulators and central banks, this is bound to amplify the urgency of discussions around the impact of stablecoins. In many cases, that response comes in the form of the development of regulatory frameworks that are conducive to the emergence of local currency stablecoins, which, while they will not necessarily resolve all of the financial stability concerns or all of the capital flow concerns around stablecoins, could at least provide a defense against digital dollarization.